Hey guys, Omar Khan here from Theta Trading with another video. I hope you guys like the content we're creating. Today's topic of discussion is Consumer Price Index, also known as CPI. Now, CPI came out on January 12th. We're going to go over the report. And now, what does that mean for stocks and the real estate market going forward? Because inflation itself, we can all feel it. You go to the grocery store, you go and you get gas, rent prices, everything has gone up considerably. Now, this is having a major impact on the stock market and the real estate market. We're about to dive into the details, but before we do, if I could ask you guys a favor, consider hitting that like button so we can promote this to more people. I hope you guys find the information to be valuable. Hit the subscribe button if you like the content we're creating, and consider booking a call with us if you want to find out what it is what we do here at Theta. All right, let's dive into the Consumer Price Index. And I'm going to pull up the report from the Bureau of Labor Statistics. Now, I know it looks kind of boring, and it does. I'm just going to enlarge it here. This is a really boring thing to go over, but it's so important in terms of what's actually going on, okay? Now, what's going on? Well, we had inflation come in at 6.5% higher this year than it was in December of last year. So this Consumer Price Index report that we got is for December of 2022. Now, they're comparing December 2022 with December 2021. We are experiencing overall inflation of roughly 6.5%. Okay, now the inflation from November to December actually decreased. It went down 0.1%. It doesn't sound like a lot, but it shows you what the Federal Reserve and the Bank of Canada and all these other banks around the world, what they've been doing is working finally. And you've seen the stock market get off to a pretty decent start of the year. And this is one of the reasons why, because it's starting to see that inflation is indeed coming down. So let's dive into the details here. It says the Consumer Price Index declined 0.1% in December, seasonally adjusted basis, after increasing 0.1% in November. Over the last 12 months, the All Items Index increased 6.5% before seasonal adjustment. Okay, now that is important. And this Bureau of Labor says we're only going to look at the first 2 pages. It's a good summary of everything, and then we're going to dive into and see what it means for the stock market and the real estate market. So looking here at page 1, you can see December of 2021, and these are month-over-month increases. So you have 0.6, 0.6, 0.8, 1.2, 0.3, 1.0, and then June 1.3. Now that is an increase over the previous month. So you can see inflation at the first half of the year was pretty bad. Now, they started increasing interest rates in the spring, the Federal Reserve Bank in the United States. Those have now had their effect, okay, or they're having an effect. Last month, like I said, we were down 0.1%. Now, let's take a look at page 2 here, okay, and see, and this is really where the details are. Now, we're going to see what's causing inflation. Now, we know that inflation was running pretty high in June. We can see in June it actually peaked at 9%. So last year, the Federal Reserve came out and said, you know what, inflation is transitory. We know we printed a bunch of money once COVID hit, and we don't think it'll be a big deal. We think it'll come down and it won't be really a big deal. That was the exact opposite of what happened. That's what they thought. And you can see inflation last December was 7%, and they realized this is not transitory. We're going to have to increase interest rates. It went from 7 to around 7.5, 8, and then it peaked at 9%. And they started increasing interest rates in March of 2022. So now you can see when you increase interest rates, what do? You increase borrowing costs. So is someone likely to buy a new home? Probably not, because interest rates are up. Are you likely to go buy a new car when the cost of financing or leasing that car is that much more expensive? Probably not. And what that does is, inflation is fundamentally too much money chasing too little goods and services. Now, you don't have money chasing those goods and services because people are reluctant to spend right now. They may be losing their jobs, real estate in the toilet, stock markets in the toilet, and people are not feeling good about their financial futures. So they are reluctant to spend. Now, this is a necessary pain that the banks around the world are inflicting on us consumers because they have to get inflation down. They just absolutely have to. So we can see here, inflation peaked around 9% in June of 2022. But take a look at what's been happening afterwards. It's been consistently coming down. That's the blue line there, okay? You can see how much it's been coming down. And today's reading at 6.5% is far better than 9%. And now we're going to be comparing it over elevated levels last year. Because remember, when you're comparing it to year over year. So for example, the next report in January is going to be comparing it to January of 2022. And hopefully this number continues to trend downwards. Now let's take a look at what's causing inflation, okay? We all know the grocery store has gotten a lot more expensive. Eating out has gotten a lot more expensive. You can see here that this is a major area of pain. Inflation, not only at the grocery store, but at restaurants and whatnot, because labor costs have gone up for them. Food costs have gone up. Now you can see year over year, all food items, okay, was up 10.4%. So that means food is costing 10.4% more than it did last year. Now, what's helping inflation? Well, what's mainly helping inflation is oil prices coming down. And that's a big one. Why? Because you have to drive to go to work. You have to drive to go anywhere you want. And also, goods are transported via semi-trucks, which mostly consume diesel. Hopefully, Tesla changes that pretty soon. But for now, they're still diesel, okay? And when costs of fuel is increased, as it has been after the war started in the Ukraine, that number has been high, but it's been coming down. So we can see energy year over year up 7.3%. So not only is food up 10.4%, energy is up 7.3%, but you can look, it's starting to come down. If you look at that December 2022 number, look where it is. It's coming down actually quite nicely. And that was the biggest contributor to inflation actually going down in December versus the previous month, November, okay? Now, again, this is all kind of boring stuff. Used cars and trucks, they are declining. It was down 8.8% year over year. So we're starting to see a lot of the effects of these interest rate hikes that started in March and have gone pretty far. Now, let's take a look at what that means to the stock market and real estate market, okay? So that's enough of the Bureau of Labor Statistics. I know it's kind of boring, but it's really important. Okay, now what does this mean for the stock market? Well, what this means for the stock market is when inflation finally does start coming down, it's easier for people to spend again. It's easier for companies to borrow money and invest more in their business, to hire people, to basically spend on growing their business. When inflation, is really high, companies are reluctant to spend money to increase their business. And also, if a company is carrying any debt, let's say a lot of companies do carry some debt, those companies, the cost of that debt has increased. So they're paying a lot of money to actually run their business. So, and lastly, I will say valuations, generally PE ratios. If you don't know what a PE ratio, it's the price earnings multiple. It's basically how much someone is paying for a stock versus how much it's earning. That gets hit pretty bad when inflation and interest rates are high like they have been. That's why we had a horrible year in 2022. Markets were down, S&P was down 19%. The NASDAQ was down over 33%. That's a terrible year. But now the good news is coming. Inflation is finally starting to come down, and I'm excited and optimistic about what could possibly take place in 2023. So now inflation is coming down. The Federal Reserve, the Bank of Canada, will say to themselves, we're doing our job. Now remember, they want to get inflation to 2%. Now we're doing our job. Maybe we don't have to have interest rates sky high anymore. Maybe we can stop raising them, and inflation keeps coming down. And we think maybe, by the summertime, they may hit that, 2 to 3% range, probably closer to 3%. And if they do that, then they may need to reverse course and start cutting rates. Now, the stock market is a forward-looking mechanism. It's pricing in today what it thinks is going to happen in 6 to 12 months from now. It's starting to think that interest rates, not only will they not stay elevated for much longer, they may actually start coming down at the end of 2023 and into 2024. And that's also what the bond market is saying. The bond market yields have been falling on the 2-year bond, the 5-year bond, the 10-year bond, and there is a correlation between what the bond market's thinking and what is actually happening. So the bond market thinks interest rates are not going to stay high for much longer. In fact, it thinks that the Fed is too aggressive and they may have to cut. So that's really good news for the stock market. And if that's the case, I would expect the stock market to perform quite well in 2023. Also, I've done a previous video on this before, but generally speaking, after a really bad year, and particularly a bad year after a presidential, third-year presidential cycle, midterm cycle. Okay, so sorry, midterm cycle. So we had the midterm elections in November. The year after midterms, the market does really well, particularly when it was down so much. So the odds are heavily in our favor that the stock market will perform really well this year and hopefully going forward. And things can get back to normal and we can get this nasty inflation down. Now, what does it mean for the real estate market? Well, real estate is very regional, right? It all depends on what city you live in, what province, what state you live in, where you live around the world. But generally speaking, when you have high interest rates, if you have a mortgage, it costs more to service that mortgage. The reason prices, and I live in Mississauga, Ontario, Toronto, Canada, and in just 1 year after COVID, real estate went bananas. It went up dramatically. And the reason real estate went up so much is because once COVID hit, the world basically came to a standstill. And the central banks around the world did the exact opposite of what they are doing now. They cut interest rates almost down to 0%. So you could mortgage a property, even an expensive property, with very little monthly payment because you could lock in a very low interest rate. Now, the exact opposite occurred this year. Okay. Now, real estate is a lagging indicator. It reacts after the fact. Now, you've had a lot of interest rate increases. People are renewing mortgages at much higher levels. That means the monthly cost to finance a mortgage is very high compared to what it was a year ago. And that's why we've seen, at least in the Toronto area, seen prices decline by about 25% from the peak. That is significant. And that is entirely, well, not entirely, but mostly to do with elevated levels of inflation. So there you have it. I think the real estate market still has a bit more pain ahead of it because, interest rates may still go up some more. The full effect of all these interest rate hikes in the real estate market have not been fully felt, meaning if interest rates went up, let's say 4% this year, and you have a renewal coming up, well, guess what? Your monthly payments are going to go up substantially. That means anyone who's looking to buy your property is going to be paying that much more monthly to do it, and that is a very difficult pill to swallow, and that's why prices have come down. But again, at the same time, they went ridiculously high because they cut interest rates to 0%. Now, I'm really excited about, some deals maybe in real estate coming up. I think in the next 6 months or so, real estate will probably bottom out and hopefully get a level state. But that will all be dependent on how many more interest rate hikes we have, and if interest rates stabilize like we think they're going to, and hopefully decline. So in the second half of the year, if interest rates start declining, real estate could perform really well because the metrics, at least in the Toronto area, are still there. And what drives real estate price in the long run? Population growth and GDP growth, right? Those are the two things, essentially. Now, population is still increasing because in Canada, we have about 500,000 immigrants per year coming in, and everyone has to live somewhere, and we don't have enough real estate to accommodate everyone. Okay. Now, if you combine that with the fact that interest rates stabilize and hopefully get cut, you could see a rebound in the real estate market. But I don't think we're going to go back to the all-time highs anytime soon because the all-time highs were largely propelled by virtually free money. You could just borrow money. You can get a mortgage at like 1.5% or maybe even less. Those days are behind us. So people are not willing to pay anywhere near as much for real estate as they were, let's say, in February or March of 2022 when the market peaked. So I'm hoping that in the second half of the year, the bond market is right and inflation continues to trend this way. The stock market will pick this up and look forward and do well. The real estate market will continue to get hit until we have interest rate stabilization or finally declining. And that's what we don't know yet. But I would say real estate is poised to do pretty well in the second half of the year in 2023. The first half of the year could still be quite choppy. Hope you guys enjoyed the video. If you have any questions, please hit the comment button. I'll personally respond. And let us know what sort of content you'd like to see. Until next time, we'll see you soon. Take care.